Well, great to have everyone along for a super important topic today, which is mortgage rates. And we've been watching gradually all through 2022, mortgage rates have been steadily increasing, which leads to a lot of questions for a lot of people. Everything from what happens to me because I have a mortgage to what happens to me because I'd like to get a mortgage. There are tons of questions. So joining me today is mortgage broker Fanchea Hayman from Wellstead Financial. Welcome, Fanchea.
Good morning, everybody.
You must be fielding a ton of questions these days.
Tons and tons and tons of questions and concerns and the usual.
Well, let's start with let's take it right back to basics, okay? So, I mean, I'm sure there are a lot of people who maybe don't follow the where's, why, fors of finance and are saying, like, what's going on? What was wrong with the way things were? Why are rates going up? And there is a purpose to what the Bank of Canada is doing. Could you give us just in basic terms, why have we been going through these mortgage rate increases?
Well, basically what the Bank of Canada are trying to do is they're trying to balance the economic damage of high inflation and against the damage of the prices of everything and going into a recession. Like, look at how much we're paying for gas now. Take a look at the grocery store. We're paying $6.99 for a pound of butter. Mm-hmm. What's happening to our cows?
Yeah.
So they're just trying to balance that, and they think that this is going to help balance everything, but it's causing a lot of problems for people.
Right. Well, we've seen with there has been some, but I don't think it's happening as fast as the Bank of Canada would like to see it happening. On the real estate side of things, we have seen a steady but very slow decrease in housing prices. I know that was it's for everything. From the real estate perspective, it was about bringing down those out of control home prices. I mean, it felt great as a seller, getting an astronomical price for your home, but it leaves buyers in a very difficult predicament when it comes to, you got it at 1.5%, but when you go to renew that mortgage, you got a giant debt. So I think that they've been accomplishing what they were looking to do, but not as quickly as they were hoping. And that's why so many rate increases.
Yes. They're trying to find a balance and try and find a happy medium. Like, it's really great when you can get those low interest rates, but you have to be prepared that your mortgage payment could potentially double.
Yes.
In 5 years. Nobody has a crystal ball. Nobody can predict what the rates are going to be. So you have to say, oh, it's great that I'm getting it at 1.9, but in 5 years, I could be paying 5%. Right. And unfortunately, this is what's happening. Like, the people who have locked in fixed interest rates in the twos, that doesn't seem like a bad rate now compared to what we're getting today at 5.6, 5.7.
That's right.
Now, that's not even talking about the alternate A market.
I have a question going to people, and I've had a number of people ask me this question, so I'm bringing it to you. People that bought their home 4 or 5 years ago, and coming up in 2023, they're looking at having to do a renewal. What should those people be thinking about? What should they be looking at? What advice can you give to people who are not looking to, but have to renew in the upcoming year?
Well, what I would get them to actually do is just take a financial analysis of your whole family profile and how much money you have to spend. If you have a lot of credit card debt, you might want to consider a refinance because you can't pay for your mortgage payment, your insurance, your food, taxes, heat, property taxes. Everybody only has so much money. So tell everybody to take a financial analysis of what they have going out as opposed to what they've coming in. They might be able to just renew if they're quite comfortable where they're sitting at right now. Just renew because the lender will send you a paper where they'll give you options to either renew at a 1, 3, or a 5-year rate. Take a look at that. It will give them the mortgage payments that they will have at those rates. And they might want to consider, okay, let's just take a 1-year term this time, just to ride the wave that we're going through this time. Or if they're satisfied with the 5-year rate that's coming out, take that. But take a hard look at what you have. Because a lot of people, like I said, would maybe want to do a refinance to accumulate and blend in some of that debt that they have to relieve it. Credit card debt is at an all-time high.
Mhm.
Do you want to have credit card debt as well as your mortgage, or do you just want to have one nice little cozy payment?
Now, is there any advantage, because if you, I mean, you follow along the articles that are published relating to what may or may not, I'm not, like you said, no one has a crystal ball, but what may or may not happen regarding the Bank of Canada, what they're doing with interest rates, chances are we will eventually reach a point where it's going to plateau for a fair bit of time, you would think. And then there's the potential that it could maybe come down a little bit. Is there any logic or any reasoning to perhaps, if you are in a position to do it, taking a short-term fixed rate, if you're renewing in 2023, maybe a 1 or 2 year, because if you take a fixed rate at 5 years in 2023, what if the rates do come down?
I totally agree. I would recommend, instead of locking yourself into a 5-year rate, because you don't know what's going to happen, take that 1 or 2 rate, or even a 3 if you don't want to go through the whole renewal process every year, because it will come down.
Mhm.
It has to. We don't want to like kill the market. I feel bad for all the brand new buyers out there who don't have a lot of down payment.
Yes.
It's very hard for them.
It is. For people that now part of the reason we've heard so much talk is because of the number of people who got in, especially over the past 2 years, with a variable rate mortgage. Now, first, I understand there are 2 ways that that's gone on. Some people had a variable with a fixed payment. Other people have a straight up variable where the payment's been going wild.
Up and down, up and down.
Yeah. So for variable rate mortgage holders, I mean, it's been a tough year, very, very tough year for them. What is the advice to a variable rate mortgage holder? Do you ride it out or do you lock in?
In my opinion, it's your personal choice. If you can be comfortable enough to ride this wave, I would do it. In my opinion, I would take the price that you're going to pay with a variable, and then go into any mortgage calculator. There's all over the internet. You can get a mortgage calculator and find out what the payment would be on a fixed rate mortgage. And if you're still saving, then that's a good thing. If you're still paying off more interest, more principal than interest, then you're still in a better position.
Okay. A question that now I reached out and had people ask questions, and I did get a few. So Joe has a question. He's heard the word trigger rate. Now that does relate to variable rate mortgages, correct?
Definitely. Yes, definitely. So what a trigger rate is your trigger rate is just an interest rate, but it's a point at which your regular mortgage payment no longer covers the amount of interest that you're paying. So when it takes effect in your mortgage payment, most of your mortgage payment in a variable is going towards principal rather than interest. And so when your balance becomes negative, when you end up paying more than what your principal is, you can end up being in a negative amortization.
Right.
Because if you're no longer paying off more principal than interest, and all you're paying is interest, you might as well be an interest only private mortgage.
Right.
So this is called negative amortization, and you don't want to be in that position. So that goes back to the next question, whether you want to stay in variable or move to fixed.
Right.
And a lot of people, they want the balance of a fixed rate mortgage because they know every 2 weeks I have to pay this. This is the amount I have to pay, where when you're in a variable, you go, okay, well, this time my mortgage payment was $800, but next week it's 925, and then it's going to 1,025. So it's a give and take.
Yeah, the variable rate mortgage is a lot more appealing when we have those lower mortgage rates, but
Exactly.
again, we have to, you know, reading what people are writing out of the Bank of Canada, it does look like there comes a point where we plateau and then gradually, I don't think we're ever going to see those 1.5% mortgages again, which is, because that's what got us here. But we will see gradually, everything is cyclical when it comes to mortgages,
Correct.
real estate, everything. So there you have it. Now, let's take ourselves away from the people with an existing mortgage and turn to first-time buyers. A lot of people would be surprised to hear there are still a lot of people in the market looking to buy their first property. The upside of this is with the rising mortgage rates, the actual prices have come down.
Yes.
In the grand scheme of things, the payments I don't think are any different now for the first-time home buyer, because before you were having to pay way more money for the house at a lower rate, but it all comes out in the wash. The difference being, and I like to tell first-time home buyers that, the payment monthly is going to be about the same as it would have been when you were paying way more for the house. However,
Correct.
when it comes time to renew, you have way less debt than the people that bought when it was a way more expensive home.
Yes.
So my question is this: are first-time buyers still having to qualify at, because of the change in the environment, are we still looking at the stress test?
Yes, we are still unfortunately looking at the stress test. It's usually the stress test is 2% above the contract rate. So using hypotheticals, if you have an interest rate of 5%, you're looking at qualifying rate is 7%. So you have to qualify as if the rate was 7%.
Right. So that's still a challenging thing for a first-time home buyer. I guess that what we should do is be advising our first-time home buyers. I don't think there's ever been a more important time than now to try and have as close to 20% as you can.
If you can get 20%, it opens up your options.
Exactly.
But then there's also other lenders. There's the banks, there's the broker banks, there's A lenders, B lenders, alternate A lenders for self-employed people. There's different ways we can try and get these people into houses. That's my job. There's nothing better than getting somebody into a house.
And as you know, and this is the nature, if you look back over history, the nature of real estate and home ownership, there are great times and there are tough times, but in the end, there really is no better investment. I mean, real estate is always the most solid investment that you can have. Plus, it's something that takes care of you day in and day out. So for Raj, who asked a question saying, I'm talking about taking the first step to buying a home. He's saying, when I contact someone for a pre-qualification, what does this mean and what do I have to bring?
Okay, when you get pre-qualified, that basically tells you how much you can possibly shop for. Okay, so what you need to bring it is all your employment docs. So if you're a salaried employee, bring me a pay stub and a job letter and a copy of your last year's tax returns. Okay. If you're self-employed, that's a whole different ball of wax. You need a lot more paperwork. And then what I do is I gather all the information, and then I give you a range of where you can go and shop for based on your income, your credit status, and varying options, how much debt you have, if you have a car or et cetera, like that. And then I put together a whole financial picture of what you can actually go shopping for. Now, just because you get qualified for 800,000 though, doesn't mean that you have to spend 800,000 on a house.
That's right.
We want to keep you, we want to keep you where you're comfortable, but not house poor, because we don't want the younger generation getting into a house and then they can't afford to go to the restaurant to have dinner because they have to make their mortgage payment. Nobody wants to do that. It's not fun.
We should mention as well that when someone comes to you and they're saying, I'd like to get that pre-qualification, know what I can spend. It's very important that once you have that pre-qualification, you don't go and buy a new truck or
No, you buy gas and groceries. You buy, because every lender has the right to pull your credit the day before the day of closing. And if anything has changed in your financial status, that you decide to go out and buy a Mercedes and your payment's $1,000 a month, if that affects your financial situation, where it affects your ratios, they can pull your mortgage and not fund. And we don't like to see that happen. So I give my clients that whole financial speech when.
That's good. That's a good thing.
Yeah.
And then once someone has their pre-qualification, like, I know I can go spend $750,000. I can find a property worth $750,000 at this rate. How long does that rate hold?
Typically lenders do a 90-day rate hold. Some you can get up to 120 days.
Okay. And for people that are getting ready to take that first step, and maybe they're thinking about it now. They're thinking about it now. They're saving, and they've almost got as much as they think they want to have for that down payment. I would imagine one of the smart steps would be to individually, before they even come to you, go in, take a look at where your credit is sitting and see what you could do about cleaning up. What are the things that people can do to make themselves more desirable in the eyes of a lender, even before they come to you?
Well, the best thing is to not overspend. Typically what affects your credit is if you spend more than 75% of your available balance on your credit card. Try to keep that below. Or when you get your credit card, if you spend $500 a month, pay it off, or let it revolve. Installation payments are good. Car payments, they like to see that. Car payments, so you're paying a regular amount every couple of weeks. They like to see that. But, and then just keep saving, just watch your spending. Don't go and apply for any credit anywhere, especially like retail cards, Visas, MasterCards. Try and watch where you're applying for credit, because that affects your inquiry level.
I'll tell you what, at this time of year, this is a good piece of advice, because you go into any of these large big box retailers and there's someone standing inside the door with a thing.
Do you want a credit card?
Yes. And it's just say no.
Yeah.
Just say no. You don't have to take one just because they're standing there giving you one. And it's honestly not worth that. Today, you'll save an extra 15% if you apply for this card. Don't do it.
No, just keep your spending where you can afford it. If it doesn't hurt to say no. It's like, I'm sorry, but I can only afford $100 per person in my family because I'm not going into debt this Christmas because I want to buy a house in January.
I think a lot of people are doing that this year, and that's actually good. That's a good thing.
Homemade gifts.
For people who are thinking about making, and maybe even afraid of making the first step because they're thinking, what if I'm not really quite ready yet? It's never too soon to come and talk to you or your team about mortgages, right?
Oh, absolutely. We're always available. We're in the office. We're available by your mobile phone, Teams. I'm always available. Always available.
And everyone can find you on social media everywhere.
Yes, we are on Facebook, LinkedIn, website, www.wellstead.ca. And I can always be reached by phone, which is 905-442-7050.
Excellent. Well, thank you so much for all of the advice, and we'll be checking in again soon because it's always changing.
Thank you. Thank you so much, Sharon, for having me once again. It's been a lot of fun.